The real reason behind record demand for U.S. 30-year Treasury Bond. Well, the CPI inflation is still at 6.5%. CPI was a breath of fresh air for bond investors who are holding TLT. It went up almost 2%, outperformed the market. S&P 500 up only 0.3%. S&P 500 got rejected at its 200-day moving average once again at the close, even after the dollar DXY lost 1%. Oil was only up 0.8%, but other commodities moved higher. Why have stocks lost their steam all of a sudden, even when the VIX was down 10% on Thursday? Why is there so much demand? Record demand from long-duration Treasury bonds, like TLT right now. Why investors want a 3.5% yield when inflation is still around 6%. What's next for the Fed? Now that short-term yields have peaked at 4.8% and declining gradually. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing, author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? What a blowout bond auction. After a stellar 3-year and impressive 10-year, both of which came in far stronger than expected, prompting us to correctly say there were zero jitters about today's CPI print in the bond market. Moments ago, we got an absolutely blowout record 30-year auction. The high yield of 3.585% was fractionally above last month's 3.513%. One of the biggest stop-throughs on record, which was especially remarkable when considering the powerful rally across the curve going into the auction and lack of concession. It was the internals that were blowout, with foreign buyers or indirect bidders, including central banks, private investors, and SOV wealth units, awarded a record 74.63%, the highest on record and far above last month's 61.57%, as foreigners just couldn't get enough. Fresh data showing inflation eased in December are likely to keep the Fed on track to reduce the size of interest rate increases to a 1/4 percentage point at its meeting that concludes on February 1st. The Labor Department reported Thursday that consumer prices fell in December, largely reflecting lower energy prices. The Consumer Price Index declined 0.1% from November. The index was up 6.5% for the year, down from a recent peak increase of 9.1% in June. The core CPI index, which excludes volatile food and energy items, rose 0.3% from November, and the 12-month increase edged lower to 5.7% from 6.6% in September. On a 3-month annualized basis, core inflation was 3.1%, the lowest such rate in more than a year and down from 7.9% in June. Fed officials have kept their options open on whether to raise rates by either a 1/4 percentage point or a 1/2 percentage point at their next meeting, saying that the decision would be strongly guided by the latest data about the state of the economy. But the improving inflation data suggests officials will strongly consider the smaller increase of a more traditional 1/4 point, or 25 basis points. It takes time for them to see the full effects of their policy actions, and they are trying to avoid causing unnecessary declines in employment and growth. In my view, hikes of 25 basis points will be appropriate going forward, said Philadelphia Fed President Patrick Thursday morning. After holding rates near zero for 2 years following the onset of 2022 lockdown, officials raised borrowing costs more aggressively last year than at any time since the early 1980s. They lifted their benchmark federal funds rate most recently by a 1/2 percentage point in December to 4.5%, following 4 consecutive increases of 0.75 percentage points. Fed policymakers want the economy to slow down, to cool demand and reduce inflation. Recent data suggests hiring has held steady, but a separate Labor Department report last week indicated wage growth moderated at the end of last year. Wage figures are important to the Fed because officials are nervous that the labor market strength could sustain wage growth that keeps inflation, as measured by their preferred Commerce Department gauge, above their 2% target. Prices of goods, such as used cars, are declining, a development the Fed has anticipated for more than a year. There is evidence that soaring rents and other housing costs are set to cool notably amid a sharp slowdown in demand, though that won't be immediately reflected in the CPI because of how it is constructed. Fed Chair Jerome Powell has recently shifted the focus away from core inflation measures toward an even narrow subset of labor-intensive services by excluding prices for food, energy, shelter, and goods. Officials believe that category could help show whether labor shortages that have been pushing up wages are passing through to consumer prices. We welcome these better inflation reports, but I think we're realistic about the broader project, Mr. Powell said last month. Despite progress on goods and housing inflation, the big story will really be the rest of it, and that's going to take time. In an interview Monday, San Francisco Fed President Mary Daly said, "I'm going to be paying a lot of attention to core services, ex-housing, because I'd like to see some improvement there." That subset of prices rose 0.26% in December, well below last year's monthly average of around 0.5%. Officials are trying to balance the risk of raising rates too much with the risk of not doing enough to slow down spending and investment, which could allow higher inflation to become entrenched. Mr. Powell said last month it was broadly right that the Fed's best way to manage the risk of over-tightening would be to slow rate increases to smaller 0.25 point increments as soon as the central bank's next meeting. It makes a lot of sense, it seems to me, particularly if you consider how far we've come, Mr. Powell said. But he said the Fed's actions would depend significantly on new information about the state of the economy and borrowing conditions. Ms. Daly appeared to endorse Mr. Powell's thinking about how to balance the risks facing the Fed on Monday. When you're being seriously data dependent, doing it in more gradual steps does give you the ability to respond to incoming information and account for those lags, she said. Most Fed policymakers last month anticipated that they would need to raise the Fed funds rate to a level above 5% this year. I think it would behoove the committee to get into that zone as soon as we can without ignoring the data, St. Louis Fed President James Bullard said last week. Today was the last CPI print that will be calculated by the current methodology. This is important. This may be one of the reasons why long bonds is in record high demand right now. February's CPI print will be the first report based on the new methodology. CPI was formally based on 2 years of consumption data. Now CPI will be based on a single year of data. Improving inflation data suggests officials will consider a small increase that in recent months. For context, 2022 CPI prints were based on consumption in 2019 and in 2020, which for most of its prices of goods and services hasn't even started going up yet. Government stimulus hasn't even reached people's bank accounts. However, 2023 CPI prints will be based off consumption in 2021 alone. What does that mean? Everything will be priced cheaper moving forward, because 2021 is when you can make more money selling your used car than when you bought it years ago. It has never happened in history of this world. In 2023, we will be comparing our price with 2021, the most remarkable insane bubble price of all time. What do you think will happen? There will be more data with deflationary taste as we're moving into the recessionary framework of 2023 as we enjoy the calm before the storm. As TLT will rise and stocks will fall in a liquidity financial crisis. And this is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an awesome book. Order your copy today. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.